Okay, welcome to the screen recording. So basically, there's many different types of investments, as you probably know, and one of the investments that we're used to is the stock market. Well, the stock market, theoretically, when you buy the stock market, it goes up and up and up and up, and you ride that along the way. Well, when it comes to things like bonds either go up or down depending on interest rates. So right now, as you can see here by this graph that I'm showing you in a moment, so what you'll see is you'll see the 10-year history of the U.S. Treasury bond. And this is an average duration of 20 years, so it's long-term treasuries. So what happens is right now, because the stock market went, quite crashing and the world currencies are not doing so well, everyone's running and fleeing to the U.S. dollar. So rather than buy a dollar as a currency, which is more risky, they're buying a treasury bond, which gives them a specific yield. Um, let's see what this yield particularly happens to be. So, if you look at the yield, right now you'll see 2.83% on the 20-year bond. So, how much lower will that go? Will that go down to 2%? Will that go down to 1%? There's always this correlation between, how low rates can go. Well, we know that you're not going to invest your money and get a 0% rate of return. You have to get some kind of rate of return. So, and then there's a relative rate to the distance or the time left remaining in the bond. So if you bought a 1-year bond or a 2-year treasury bond, that would expect to pay a lower yield than a 20-year bond. Let me show you real quick. So we go to finance, a little bit slower. I'm going to pause this. Okay, back to where I was just a minute ago. So you can see the treasury bonds here. If you do a 3-month treasury bond, the yield is basically zero. Unbelievable. 6-month treasury bond is 0.08 as of yesterday. And the 2-year is 0.60. That means less than 1% per year for 2 years. 3 years you get 1%. 5 years you get 1.6%. 10 years you get 2.16. And 30 you get 2.18. So, again, these all have a relative time to maturity, and then relative to the rate of return you're going to get. So if you're locking your price for longer here, well, who would lock in a price for 30 years at 2.8%? Well, that's what I say. I say you really shouldn't do that. So right here, these people in the TLT, which is an average maturity of 20 years of U.S. Treasury bonds, they're locking their rates in at the current yield of 2.83% for the next 20 years. I say that that's a bad bet. I say that rates will eventually go higher. Um, so, if we look at the history here, you will see that in the course of the past, let's say, 10 years, you will see that this TLT is here. When rates go lower, then when rates go lower, the price goes higher. When rates go higher, the price goes lower. So you can see here rates are very low, or historically from 2005 or so. This fund or this ETF is averaged, in this range over here of $90 per share. Well, in 2008, after the crash, everyone said, "Whoa, well, we can't put our money in the stock market. There's no safe place in the world to go." So they went to the U.S. Treasuries, and it went up to 120. And then everything started normalizing again and said, well, that's ridiculous. It's too low. And then it went back down to the 90. And then in 11, then the currency started becoming really, really strong again. I don't know what was happening then. And you're dealing with 129, as you can see over here in the right-hand corner, that it went up to as high as 129.7. And then, of course, it'll go back down again. Didn't quite reach the 90, but it went down to 100. Well, that's a 30-point difference, almost a 30%, difference. So you can see that rates just really can't get too much lower, or historically they never have. Okay, so maybe it goes back up to 129.7. Maybe even for flukes out here and goes up to above 130. Okay, but again, they can't start giving negative rates, where meaning you can't start putting your money in with the government and you have to pay them money just to keep it there. That doesn't make good sense. So right now we're up almost to the historical high again, and eventually at some point in time it will go back to here and here again. So your downside here is from here to here. Okay, that's your downside, which is a few percentage points, and hopefully over the next day or two or week, this number will move up to the 129 range or something like that. And if so, it makes sense just to buy. Again, it could go in the 130s. It's possible. It's possible to stick there for 6 months. But again, where's your downside? It's not going to go up to here. It's not possible. Again, you're not going to have negative interest rates. And then you just simply wait until it goes back down to here. What I personally do, since the yield is small, the risk is very low, where you can only possibly lose a few percentage points on the downside, I would leverage this. But we know our upside is about 30 points to 40 points. So I would leverage this, and I would do 3-to-1 leverage, and that means I would sell it short. So I'd sell bonds here, betting that interest rates will go up in the future. And when interest rates go up in the future, it'll go down to here or here again. And that's my bet. When I leverage it, I could leverage that and get 3-to-1. So instead of getting a 30% rate of return, I can get a 90% rate of return if it goes back down to 101, as an example. Hopefully this helps you. Thank you so much.